Good afternoon, ladies and gentlemen. Here's my second video on YouTube. Happy Easter. Hope we're having fun. Just to let you know, the markets over the last 6 days have gone that way. Hold your hopes out because still some volatility left. We don't know the impact yet on all the economies around the world, but it's encouraging. That's the main thing. So if you've got investments with me and you logged in, you would see an increase from the lows, which is great. Now today's about diversification. Shares in, say, one company, Lloyds Banking Group for example, when they were £10 a share roughly, they reduced to about 11p after the financial crisis. Wrong time to sell, time to buy. So what I'm going to talk about is, with diversification, is about the difference between owning just a handful of shares and owning a portfolio of shares. Now then, there's four main assets: cash, bonds, shares or equities, and property. There are more than four main assets, however, these generally are the main stay of most portfolios. There are other things like gold and derivatives, commodities, for example, but they all have different characteristics. Now, if you went into cash only, well, yes, it's going to be safe. It's not going to give you a great return over the long term. I think since 2009, when interest rates were slashed again last week to 0.1%. But if you put all your money in a bank or a building society that's for a nest egg in future, you're taking one hell of a chance, because cash is a very predictable asset, very boring. In other words, you know what you're going to get. If the bank tells you after a year you're going to get 0.5%, that's what you're going to get. If they tell you to get 2% fixed after 3 years, that's what you're going to get. But all of those are going to be in a fight with inflation, so the buying power of that money in future years may not be the same. Bonds, when I talk about bonds, I don't talk about building society or bank bonds. I talk about bonds that's issued by governments and companies. Government bonds are an IOU. You lend the government money, they give you back your money at the end of a specific term, but in the meantime they give you interest. Company bonds, exactly the same thing, called corporate bonds. You give the company money, or lend the company money, and they give you back a rate of interest over a specific term and give you money back. So usually large companies do that. Small companies do it as well, but they are classed as junk bonds, where you get a great rate of interest, but you could lose your capital. They could go bust. Shares, which traditionally with lay people is the scary one, because they can go up and down. Of course they can. That's the nature of shares. When you buy a share, you're buying a share in the company's profits. If you buy 100 shares, you'll always own 100 shares. If the share price goes up, you say you bought it for £1, then the value of your share goes up accordingly. In the interim as well, you'll get another share of the company called a dividend, usually paid every 6 months, and that dividend is paid to you either into your bank, or you can buy more shares. And the last one is property. Very much like our own properties, these companies invest in commercial property, like shopping centres, industrial estates, big office blocks, and they partake in the rental income, but they can also own the property outright as well and sell it at a later date. So don't put all your money into cash, don't put all your money into government or corporate bonds, don't put your money in shares exclusively, and don't put your money just in property. Try and get a mixture of all of them. Now what I do in my profession is, when I see clients, we establish what their attitude to risk is. Then, depending on where they sit with risk, depends how much of their money goes into each section. It's given out to about 9,000 different investment professionals in 200 countries. So not only you're spreading the risk by diversification in different assets, You're also diversifying further around the world, and you're also diversifying even further by giving your money to about 7 or 8 different fund managers. So you're relying on the expertise and management skills of those companies. So typically most portfolios own thousands and thousands of different assets that I do. As I said earlier, depending on your attitude to investment risk or risk appetite when it comes to investing, depends on how much in each of these assets you do. Now this is not representative. But thousands and thousands of assets are in these portfolios, and they are managed by all these managers. But contrary to belief, they're not like headless chickens running around the stockroom floor. These management houses, I've been to quite a few in my time. The most recent was Threadneedle. And the investment houses are like libraries. They are very, very quiet. All they're doing is researching. They've got folders on their desks. You'll have the fixed income desk, which is the bonds. You'll have UK equity desk, European equity one, property desk. And they all got their own brief where they look for value. So they don't just pick a company and then invest straight away. They'll spend quite a bit of time researching, looking at the management structure, see if it's a good time, what their long-term view is, or what the company they want to invest in long-term view is. So all these things go into the mix. Then they'll say we'll invest X amount of money into government bonds this week because there's a bond auction. They might say we're pulling out of, when I was there was a company called Williams Holdings. So they pulled money out of Williams Holdings and put it into another company because they foresee further down the line, they want that confidence about where the company was going, etc., etc. So diversification rules, guys. So if you're going to invest, as I say, now is a great opportunity. I always talk about it's not the time in, but it's the time in there that counts. But what a fantastic opportunity to open your ISAs, to add to your funds, etc. To drip feed as well, because I've had a lot of inquiries this week about putting money in on a regular basis as opposed to a whole lump sum. Yeah, that's a good idea. As I said last week, it's pound cost averaging, where you buy in lots of units at a lower price. The following month they may go up, so you buy a little bit less for your money in units, and the following month again they could go down, so you buy more for your money again. So that's pound cost averaging. So that's today's video, short and sweet today. Some good news in the markets, but don't be too overly optimistic. You just gained, I would say, about 10 or 12% of your 25% loss back currently, depending on which fund you're in, of course. And the other thing is about diversification of assets. Don't invest in just one asset. Don't invest in just one company. Invest in several through me. And you should do well in the longer term. Okay, thank you very much. Happy Easter, everyone. I'll see you next time.